Welcome to Talk Tickers. We are tearing into the Q3 2025 earnings call results, which landed just ahead of the Hong Kong market open this morning.
That's right.
And the market reaction seemed pretty swift, pretty positive.
Yeah, definitely positive. Driven by, raised guidance and these clear signals that management isn't just hitting targets. They seem to be accelerating their whole integrated strategy.
Okay.
That market response really tells us the results. Delivered a powerful message, a financial inflection.
Right.
So our mission in this deep dive, as always, is to synthesize the data for you. We need to extract that core financial quality, understand the implications of their strategic pivot.
Which seems to be driving profitability.
Exactly. And analyze the updating capital allocation, the outlook, especially, as they navigate this geopolitical environment with some pretty aggressive global capacity expansion plans.
Okay, let's unpack this then. We don't just want the numbers, we want the insight, right? What they actually mean.
Precise.
So give us the snapshot. Synthesize those key financial drivers that seem to convince investors this morning.
Okay, so the core insight, I think, is this. The divestiture strategy. It's working. It's driving a massive improvement in quality.
Okay.
Total Q3 revenue was RMB 12.06 billion. That's a respectable 15.3% year-over-year growth. But the key metric, the one to watch, revenue from continuing operations, that grew even faster, 19.7% year-over-year, hitting RMB 12.04 billion.
Almost 20% just from the core ongoing business.
Exactly. And this selective growth, it culminated in profitability just soaring. Year-to-date adjusted non-IFRS net profit.
Right, that's their core operational earnings metric stripped of the accounting complexities.
Correct. That increased by a staggering 43.4% to RMB 10.54 billion.
Wow. 43%. That profit surge is exceptional. And, looking at the share price movement, the diluted EPS earnings per share for the first 9 months nearly doubled, up 87.9%. But let's be critical for a second. How much of that gain is really operational strength versus the benefit of those aggressive share repurchases and cancellations management executed?
Yeah, that's an excellent point. And look, while the repurchases certainly enhance the per share metric, no question, the fundamental operational gains, that 43.4% increase in the absolute non-IFRS net profit, that confirms the primary driver is internal efficiency and just high-quality sales.
Okay.
The financial engineering acted more like a powerful accelerator on what were already great results.
Oh, that makes sense. Okay. And if you're looking for evidence that this operational strength is actually sustainable, well, you have to look at the backlog, don't you?
Absolutely.
That's probably the most important metric for forward visibility.
It really is. The backlog for continuing operations hit a new historical high, RMB 59.88 billion as of September 30th.
59.88 billion.
Yeah. We are talking about 41.2% year-over-year growth in guaranteed future work. It's massive.
41% growth in the backlog. Okay.
Yeah, precisely.
Yeah.
And that backlog, that's the tangible result of their strategic focus.
Yeah.
Which has really been about eliminating complexity and just doubling down on their core strength.
Yeah.
That CRDMO model.
Let's delve into that strategic narrowing now, because this is where management showed some real discipline this quarter, I thought. They announced a divestiture that signals they are maybe ruthlessly pursuing the highest margin, most scalable parts of the business.
They did, yeah. They agreed to sell their China-based clinical research services, specifically the lower margin clinical CRO and SMO site management organization business.
Okay, who'd they sell it to?
To Hillhouse Investment for RMB 2.8 billion.
Right.
And this move, it explicitly sharpens the entire company focus onto chemistry, research, development, and manufacturing, the CRDMO model.
Okay.
And while that divested clinical business was, relatively speaking, small, only contributing about, 3.5% of year-to-date total revenue?
Tiny.
Its removal is projected to immediately improve the margin mix of the remaining testing business segment.
Oh, okay.
So it's a classic move, right? Drop the minor, complex operations to elevate the profit profile of the whole thing.
And the results of that laser focus are already showing up immediately in the core segments.
Yeah.
Chemistry revenue, which you said is the engine room of the CRDMO strategy, grew almost 30%. 29.3% year-to-date. But the true star here, and probably the future driver of margin, has got to be Tides.
Oh, absolutely. Tides growth is, it's arguably the most compelling part of this whole story.
Explain Tides again quickly.
Right. So this is their highly specialized, high-margin business focusing on large molecule therapies. things like oligonucleotides and peptides. Very complex.
Got it.
They achieved massive revenue growth here, 121.1% year to date.
Wow, doubled revenue.
More than doubles, yeah.
Yeah.
And this kind of ramp, it's about more than just demand. It's really about execution and having the capacity.
Right.
Management confirmed that new capacity is ramping up successfully. Total reactive volume for solid phase peptide synthesis now increased to over 100,000 liters.
100,000 liters.
That's a massive commitment to a very complex manufacturing process.
And globally, who's actually driving this demand? Is it still concentrated?
Yeah, the U.S. continues to be the dominant customer base. U.S. revenue grew a strong 31.9%.
Okay.
So the execution is proving global in scope, definitely, but the revenue strength remains rooted in, Western biotech innovation, primarily the U.S.
Okay. So this successful execution, this shift toward high-margin projects like TIDES and also the late-stage clinical trials, this leads directly to maybe the biggest operational surprise, that margin expansion.
Absolutely. Yeah, this is where the story gets really interesting, I think, for the sophisticated investor.
Okay.
The year-to-date adjusted non-IFRS gross margin increased by 610 basis points year over year. It reached 47.0%.
47% gross margin and 610 basis points. I mean, for context, a 600-plus basis point improvement in gross margin in a single year within the specialized CRDMO sector,
Right.
That's a huge inflection point, isn't it?
It's massive, yeah. It typically signals a complete reversal of maybe prior utilization issues or pricing pressures. Something significant has changed.
So what specifically is driving that unprecedented inflection? What did management say?
Well, management credits it to three things basically working together. First, deep operational efficiencies in manufacturing. Second, optimized processes. And third, that highly favorable mix shift we talked about.
Towards TIDES and later stage projects.
Exactly. As those thousands of molecules in their pipeline, they mentioned 80 commercial projects and 87 in phase 3, as those convert into manufacturing orders, facility utilization rates just rise dramatically.
Right.
And when a specialized high-tech factory runs full bore, margins explode upward. And that's exactly what we seem to be seeing here at 47.0%.
That confidence in operational delivery, it clearly translated directly into significantly revised guidance then. Let's talk about those for-year revisions, particularly interested in the signal management sent regarding cash generation.
Yeah, they raised confidence pretty much across the board. Total revenue guidance for the full year 2025 was raised, now RMB 43.544.0 billion.
Okay.
And crucially, the growth rate for continuing operations, that core business post-divestiture, that was revised upward to 17-18%.
Up from 13-17% before.
Right. So that reflects stronger confidence in that streamlined business model actually delivering.
But the real kicker, I think, for investors focused on capital returns was that disciplined approach to free cash flow and capital expenditure. This is where they showed restraint and that increased efficiency, right?
No, precisely. Yeah. The free cash flow, or FCF, outlook was massively increased. Now, RMB 8.0, 8.5 billion, that's up from the prior RMB 5.06.0 billion forecast. Huge jump.
Huge.
And simultaneously, they trimmed capital expenditure, the CapEx, down to RMB 5.56.0 billion from the original RMB 7.08.0 billion estimate.
So more cash coming in, less cash going out on big projects.
Exactly. And that juxtaposition, that's the financial proof that those prior investments in capacity are now bearing fruit efficiently. They require less cash now to support that record, nearly RMB 60 billion backlog.
Makes sense.
Furthermore, they underscored their commitment to shareholders, implemented RMB 6.88 billion in dividends and repurchases this year already.
6.88 billion.
Yeah, representing over 70% of 2024's net profit being returned.
Okay. So while the financial execution is, well, sparkling, we have to address the persistent macro and policy headwinds. They're a central concern for this whole sector.
Always are.
The discussion around the proposed amendment to the NDAA 2026, what people often call the biosecure bill, that was essential. What was the update on the language there?
Yeah, the update was, I'd say, cautiously positive, but it definitely underlined the ongoing uncertainty. Management confirmed that the proposed amendment included in the Senate version of the NDAA 2026 did not specifically mention the company's name.
Okay, that's good news for them.
It is. And neither did other proposed House or Senate legislation drafts they're aware of. So this is temporary relief, at least. It alleviates those immediate fears of being named in the draft language right now.
So the immediate threat seems mitigated in that specific draft, but the sort of systematic risk remains, right? What was management's assessment of how they're dealing with the wider policy uncertainty.
Yeah, they were very clear. They said, look, the legislative process is complex, it's uncertain, and it's subject to constant evolution and modification. Things can change.
Sure.
However, they emphasize that U.S. customer demand for their core CRDMO services remains strong. They see no change in the pattern of requests or demand coming in.
So business as usual from the customer side.
That's what they're saying. And their strategic countermeasure, really, is to accelerate global capacity expansion outside of China. It's a long-term commitment that helps insulate them from that systematic geographic risk.
Right, diversification. And what does that accelerated global build-out actually look like on the ground? What are the specifics?
Well, it's aggressive, and it seems targeted at high-value products. They're moving forward with an API manufacturing plant in Singapore. That's expected to be operational in 2027.
Okay, Singapore.
More immediately, a U.S. drug product facility will be operational by the end of next year.
End of 2026.
Correct. And they're also utilizing and expanding their existing facility over in Switzerland. So this multi-site, multi-geography approach, that's their clear strategy to meet global customer demand and de-risk their systematic footprint over the long run.
Fantastic. Okay. Now for our required segment. Just a reminder, the following is not financial advice, and you should always do your own diligence, talk to a professional.
Absolutely.
But based on the exceptional operational results we just reviewed, we're pitching an outrageous but plausible trade idea, something suitable perhaps for an investment committee to debate.
Okay. So the thesis here is this.
Yeah.
The market is still heavily discounting this company, probably because of that geopolitical uncertainty we just discussed. And it's fundamentally underappreciating the profitability inflection that was confirmed by these Q3 numbers.
Right.
And this inflection is driven by two, I think, pretty unassailable facts. That strategic streamlining to a pure CRDMO focus and the successful massive scale-up of the high-margin Tides platform.
Yeah, that 610 basis point margin expansion and the massive free cash flow raise, I mean, that's undeniable proof of operational leverage hitting hard, especially in Tides where growth is, 121%?
Exactly. Therefore, the trade idea we propose is a pair trade, structured for, say, 12 months.
Okay, long short.
Correct. We go long on this hyper-focused company, and we short a peer find a diversified, lower-margin legacy CRDMO model. One that maybe has minimal Tides exposure and is perhaps struggling with its own capacity utilization or margin pressure.
Okay.
Since a competitor likely lacks the 47% year-to-date gross margin and certainly lacks the phenomenal, plus 41% backlog visibility, this pair trade aims to capture the operational alpha being generated by this specific company.
Makes sense. What's the target?
We target something like a 15% outperformance relative to that diversified peer group over the next 12 months. Driven purely by the sustained conversion of that nearly RMB 60 billion backlog.
And the raised free cash flow guide is kind of the ultimate confirmation of the capital discipline backing it up.
Exactly. It confirms the operational excellence and the capital discipline are real.
Okay, that thesis really leverages the divergence between what looks like disciplined execution on their part and that systemic uncertainty hanging over the sector. It does it beautifully. The cash generation is proving sustainable, and the focus is clearly paying off.
It truly seems to be, based on these numbers.
So, to recap the essential takeaways then from this Q3 call, we have a record RMB 59.88 billion backlog, which guarantees significant long-term revenue visibility.
Huge visibility.
We have major margin improvement, driven by that shift toward high-value projects like Tides and just operational excellence.
The 47% number is key.
And disciplined capital allocation, confirmed by the raised FCF guide and the trimmed CapEx.
Right. They're generating more cash and spending less capital to do it.
Okay. So the question then for you, the listener, to mull over now as you digest these results is this.
Yeah. Considering the success of this global capacity build-out, especially in those high-value areas like Tides, how much farther can that non-IFRS gross margin actually climb above 47% before competitive pricing pressure eventually forces management to maybe share more of that profitability back with customers, something they suggested they might do to maintain market share down the line?
A fascinating test of their future pricing power indeed. That wraps up this deep dive into the Q3 2025 earnings call. We'll see you next time on Talk Tickers.